Hello, my name is Doug Greenberg, President of Pacific Northwest Advisory, and here is March's 5 slides in 5 minutes. As an investor, it's important to maintain a level-headed perspective in the face of economic indicators. The recent data, as depicted in this graph, suggests that while the job market is experiencing a slowdown, it is not indicative of a crash. The monthly payroll changes show variability, which is normal in any dynamic economy. But the overall trend has not plummeted. Instead, it indicates a cooling period where job growth is more moderate compared to the previous highs. For you, this means maintaining a diversified investment portfolio is more crucial than ever. Economic cooling can have mixed effects on different sectors, and while some industries may slow down, others may continue to grow or even benefit from such a shift. It's wise to avoid making hasty decisions based on short-term fluctuations and focus on the long-term health of your investments. Moreover, a cooling job market does not necessarily correlate with poor stock market performance. In fact, sometimes the market has already anticipated such changes and priced them in. Keep an eye on the fundamentals of the companies you invest in rather than overreacting to macroeconomic headlines. Stay informed, but also stay steady with your long-term investment goals. It's noteworthy to see that passive fund assets have now matched the totals of active funds. This trend, as shown in the graphs, has evolved over the years, indicating a significant shift in investor preference. For many, passive investing through index funds and ETFs offers a low-cost, diversified strategy with the potential for steady long-term returns, closely mirroring market averages. Active investing, while potentially offering higher returns, often comes with higher fees and the risk that comes with fund manager stock picking strategies. The second graph illustrates that active management can lead to outperformance in certain categories, but it's not consistent across all sectors. What does this mean for you? It highlights the importance of understanding your investment style and risk tolerance. If you prefer a set it and forget it approach, passive investing might align with your goals. However, if you're willing to take on more risk and believe in the value of professional management to outperform the market, you might consider an active approach in specific sectors where active management has historically done well. The visual data suggesting a depletion of U.S. consumer excess savings is a significant economic signal. The charts indicate a substantial buildup of savings during the early phase of the pandemic attributed to to reduced spending and increased fiscal support. However, the trend is reversing, with savings levels decreasing as outlays on goods and services rise and government support wanes. What this means for you is twofold. Firstly, it might be wise to revisit your emergency fund to ensure it's robust enough to withstand further economic fluctuations, especially if consumer savings continue to dwindle. Secondly, this could influence consumer spending behavior, which has broad implications for the stock market and various sectors. Investors may want to look at companies that benefit from increased consumer spending or consider sectors that are more recession-proof should the savings continue to decline and affect purchasing power. It's also a reminder of the importance of a long-term investment strategy that takes into account economic cycles and consumer trends. Keep an eye on the broader economic indicators and consult with an advisor to help navigate through these changing times and to make informed decisions about your investments. For investors, understanding consumer confidence is pivotal. The latest charts show two key indexes, the University of Michigan and the Conference Boards. Both are predictors of consumer spending and confidence. As of February of 2022, they're not aligned. The University of Michigan's index is notably higher. The divergence reflects consumer ambivalence impacting spending and thus the stock market. High confidence usually means more spending and market growth, but uncertainty now looms. Investors should monitor these trends, especially if invested in consumer sectors. Considering both indices for a well-rounded view is wise, aiding smarter portfolio choices. Amidst these mixed messages, diversification remains a sound strategy and being prepared for volatility is key. By keeping abreast of these indicators, investors can face market shifts with more assurance. Looking at the recent data, there's a fascinating divide between investor sentiment and economic sentiment. Investors, it seems, are riding a wave of optimism with a strong bullish stance, according to recent surveys. This reflects confidence in the markets and a belief that stock prices will continue to rise. On the flip side, when we peek into the economic sentiment, gleaned from surveys on economic activity and expectations, there's a palpable air of caution. Pessimism seems to be the underlying tone, with worries about a potential recession not far from thought. This dichotomy is something that the average American investor should be aware of. On one hand, the enthusiasm in the market can be infectious, and the urge to follow the bullish trend is strong. However, it's crucial to remain grounded and consider the broader economic indicators that suggest caution. As history has often shown, these sentiments will eventually move to close the gap. As an investor, this means maintaining a balanced perspective, be open to opportunities, but also mindful of risks. It's about finding that sweet spot where you can capitalize on market optimism, but also protect yourself against potential downturns by diversifying your investments and staying informed on economic trends. Remember, the key is not to swing to the extremes, but to navigate the middle path with prudence and a clear strategy. The latest survey from Bank of America, capturing the sentiments of global fund managers, paints an optimistic picture of the stock market with a touch of caution. Growth expectations and stock allocations have hit their highest marks in 2 years, signaling strong confidence among investors. Yet 40% believe AI stocks might be in a bubble, highlighting an area of concern. Popular trades include investing in major tech stocks, Japanese equities, and even cryptocurrencies like Bitcoin, while some are betting against Chinese stocks. Despite the enthusiasm, the survey also shows a significant tilt towards risk, with the highest risk appetite recorded since late 2021. Interestingly, fears of a recession seem to be waning, with 2/3 of investors now doubting a downturn is imminent and anticipating a soft landing for the economy. This backdrop of bullishness amidst caution comes just as the Federal Reserve contemplates its next moves on interest rates, with the market hopeful for steady rates leading to continued momentum in stocks. For the investor, this scenario suggests a landscape ripe with opportunities, albeit one where vigilance against potential overvaluations, particularly in AI stocks, is advisable. Thank you for listening, and if you have any questions, please let me know. Thank you.